Despite the sharp recent slowing in housing sales, home builders have actually stealthily outperformed the S&P 500 this month. My next guest has been steadfastly bullish on the builders and isn't giving hope just yet. Joining me now is Stephen Kim. He's a home builder analyst at Evercore ISI. Stephen, it's great to see you again. And why do you think the past month, is it just because rates, especially in the last week or so, have stopped rising?
Well, I would say that probably the most important, reason is that housing has slowed a little, but not nearly enough for the bear case to be proven out. And in fact, when the builders all reported, a few weeks ago, all the analysts pretty much had to take their estimates up across the board. And so if you look at all the estimate revisions, they're up and to the right. And in addition, book values continue to grow. When stocks are trading at or even below book value, if that book value keeps going up, it pulls the stocks up with them. What
are 2 or 3 takeaways from what the builders reported that you think investors need to be mindful of?
It's the number one thing is that they are continuing to raise price because the market dictates it. The prices are up in the existing market, which is really what sets pricing for the whole industry. Pricing's up about 1% a month in the existing home market. Homes are continuing to sell above asking routinely, which is unusual, obviously, and the builders are not incentivizing significantly. They haven't had to increase their incentives to try to coax buyers in because the demand is still outpacing the supply. That's probably the most important thing.
Do you think home prices are going to drop?
I think home price growth will slow. I do not think you will see home prices drop measurably in this year. That has actually been the crux of our thesis, because our point that we made, a month ago was that the builder stocks were pricing in about a 20% drop in home prices over the next couple of years. We are absolutely resolute that that will not happen.
Why don't you think that'll happen? It might be bad news to people who are trying to get into the market.
The number one reason is because the main reason you get home prices to go down is you have forced selling, which is what you had in the GFC in the mid to late 2000s. You had people who could not afford the homes that they were already owning. Because they shouldn't have been able to buy them in the first place. They were using adjustable rate mortgages and other crazy mortgage products. They could not afford the homes they already owned. That does not happen today. In fact, if you look today, the average person who has a mortgage has a rate of about 3.4%, incredibly low rate, and that rate is fixed. 95% of the mortgages out there are fixed, and so basically their payments are not going up. So when demand gets a little shaky, when things soften, they stay put. They don't go out and sell their home. In the GFC, they were forced to sell their home because they could not afford the home they were already owning.
The only way I can understand this group trading at, let's just call it 5 times earnings, is if earnings are about to fall by 50% or more, Is that still mathematically possible this year or next year?
Well, I mean, if you listen to somebody who's concerned that home prices are going to go down a bunch, well, sure, I suppose. It won't happen for at least 2 quarters, though, because the builders have pre-sold backlogs that they're working on trying to construct. So for the next 6 months, you're going to continue to see largely what you've been seeing, no matter what, really. But yeah, I mean, I think that, as I said, the disagreement right now in these stocks, and the bears, I would say, largely are dominating the conversation, is that home prices are going to go down. And I would just tell you that if you had told anybody 6 months ago that mortgage rates would have shot up 220, 240 basis points, they would have expected, anybody would have expected that you would see more weakness today than you do. You should already be seeing weakening. You should be seeing incentivizing by builders. You should see people getting, having to take action to bring more customers in the door. That is not what you are seeing.
So I believe you're overweight on pretty much the entire space, but do you have a favorite or two? And is there anyone you're underweight on and would kind of be less bullish on?
I think right now the big call in the space is to get the industry right. I think the fundamentals are going to be what's going to drive things. And frankly, right now the group is being painted with a broad brush. There are no individual builders that are being carved out and saying, oh, we like this one. When people think home prices are going to drop a lot, they don't like any of them. I don't think home prices are going to drop. I'm not seeing any evidence of anything like that. And so I like all of them. And I think that, frankly, there's not one that I would particularly call out. They're just so unbelievably cheap. And by the way, Kelly, they are way cheaper than 5 times earnings. The street, on top of everything else, has been way too low on their estimates. On my numbers, a lot of these builders are trading at 3 times earnings or less.
Wow.
And the street has been coming up to our estimates consistently over the last year and a half.
It's crazy to watch. I really haven't seen multiples like this. I mean, outside of truly crisis events in any industry, in any thing in recent memory. That's what makes it so fascinating to talk to you about. Stephen, thanks for your time today.
Sure. Thanks for having me.
Stephen Kim with Evercore ISI.